You may be sitting on tens or hundreds of thousands of dollars of equity in your house. And today I'm going to talk to you about how you can access it to either buy a new property or to buy an investment property. So it's a common theme right now that a lot of people have current low mortgage rates on their first mortgages. Listen, rates were artificially low for many years. So a lot of people have these very low interest rates and they're thinking about either buying a new house and they want to rent out their existing, or they're thinking about buying investment property. But the thing is, you don't want to get rid of that mortgage because the rate is so low. So it's important to figure out how can we tap that equity to create future investments. And we do that either through a home equity line of credit or a second mortgage. That way we don't touch that first mortgage. So this is your step-by-step guide. Step number one, you need to calculate your home equity. So you can do this through a variety of online tools, many websites like Zillow, calculate what's called the Zestimate, or there's other online tools that can provide you a valuation of your current house. So that would be the first step, is to figure out what do you think the current value is. If you want to take it a step further, you could contact the real estate agent that sold you the house and ask them to run a CMA for you. It's a simple report that they could run that would give an overall valuation based on the current comparables. That would give you a really good opinion of value on your current property. And then take a look at your mortgage statement to determine your mortgage loan balance. And then what you want to do is deduct that from the valuation you have. For example, let's just say the value of your house is $500,000. Your loan balance is $250,000. That means you have $250,000 of equity in your house. That's real money. And what a beautiful thing. And this is why I love helping homeowners buy houses, because the wealth that you can create through real estate is like nothing else. And it's like a forced savings account. And that equity you can do a lot of things with. You could start a business. You can invest in other properties. You can upgrade your property. You can put your kids through college. There's a lot of things you could do with that equity. So it's such a beautiful thing. So that's how you calculate your equity, is just the valuation of your house less the mortgage balance. That's your equity. Now let's talk about step number two, your options. How do you tap into that equity? So there's really two different ways you can do it. You can do it through a home equity line of credit or a second mortgage. Now, what is the difference between a home equity line of credit and second mortgage is really what it sounds like. A home equity line of credit is essentially a line of credit. Like, think of it as a big credit card tied to your house. And typically these can go up to about 90% of the value. Same with the second mortgage. Second mortgage is just going to be a fixed amount. So when you get a second mortgage, they're going to give you the money at closing. It's a fixed amount, and then you're going to repay it for 15, 20, or 30 years, the same as you do on your first. The home equity line of credit is going to be a big line of credit. So you only pay interest on whatever you take off the line. So if you have a $200,000 line of credit, for example, and you only use $20,000 of it, you're only paying interest on the $20,000. You can pay it back and take it off as many times as you want over 10 years. At the end of the 10 years, that line will close and convert to a principal and interest loan to be repaid over the next 20 years. Those are the two ways that you can do it, through a home equity or a fixed second. And typically you can go up to 90% of the value of the house. So the pros and cons of each would be, listen, if you're looking to tap in your equity for, maybe you're going to start doing fix and flips as an example, and you're going to buy little dilapidated houses, fix it up, and then sell them and repay it back. And you want the flexibility of pulling money from the line of credit and paying it back. That's where you'd really want a home equity line of credit, is if you have these variables. If you have a fixed amount that you need, so for example, let's just say you're buying this little investment property and you're going to pay cash and it's a fixed amount, you're going to keep that property long-term, then it's best to have a second mortgage that's fixed. Your rate will be fixed. Your payments will amortize. The loan will get paid down over time. It'll just be a better option. So a good loan officer should be able to explain the two differences to you and help you guide you into what the best option would be. And step number three, you want to make sure you calculate the correct debt-to-income ratio. So listen, if you're pulling the equity out of your current place, you're now going to have a monthly payment attached to that. So let's just say you're taking out $100,000 to buy the next property. There's going to be a monthly payment attached to that transaction. You're buying now the investment property using the $100,000 as a down payment. The lender's going to have to make sure that your overall debt-to-income ratios will now qualify with that higher payment that's going to be on your credit report. And also, you're going to want to calculate your overall return on investment. So if you're buying an investment property and you calculated all your your payments and your expenses and your income on it, and you're coming up, say, with a 12% return, are you calculating also the money that you borrowed from your equity and that payment as part of that ROI? So it's important to calculate everything together. Number one, for qualification, but number two, to make sure you have a great investment on your hands. So step 4 will be to actually use those funds from your home equity line of credit or second mortgage to buy your new property. So how are you going to do that? So let's just say you're buying an investment property. Typically speaking, you're going to do 20% down on that property. You're going to use the money from your existing home as your down payment on the new house. And again, assuming if the return on investment works, the ROI, you've now bought that house with no money out of pocket. You leveraged your current equity to now own and control an investment property. So now you're going to get the appreciation upside, you're going to get the tax advantages, and you're going to get the rental income from that with no money out of pocket, just leveraging your equity. The other option would be to buy a new, say, primary home. So in a new primary home, you don't have to do 20% down. You could do, say, 5%. So maybe you only take a small amount from your exit property as your down payment. And what's the benefit of that? You can leverage your current property to buy your new property with no money out of pocket. And you can now rent your exit property. And the great thing about that is if you have that low interest rate on your first mortgage, your overall payment is going to be super low. So more than likely, you're going to have a really nice cash flow on that exit property. But again, you want to run all of your numbers to make sure that you're going to have a good cash flow, a good return on investment on the exit property before you buy the new property and rent the exit. It's also a little easier to qualify because you can now have that rental income to offset the mortgage payment when you're buying your primary residence. And step 5 is tax and strategy considerations. So listen, one of the beautiful things about leveraging your equity is that you can pull tax-free money out of your property and use that as your down payment. What are the other options? You can continue to work, make money. Let's just say you need $70,000 for a down payment. That means you have to make $100,000 of income, get taxed $30,000 to save $70,000. That could take a long time. So you also have opportunity costs there. Maybe that's going to take you 3 to 5 years down the road to save that money. And homes are appreciating at 4 to 5% per year. I mean, we're talking on a $500,000 house, like $25,000 homes are going up in value each year. So you could lose $100,000 by just waiting. The great thing about tapping your home equity is that it's going to be available immediately if you have it, and you don't have to pay taxes on it. So that's a great strategy. Another option too, other things that just to consider is that if you've owned your primary for at least the last 2 years, that equity in there is tax-free. You could actually consider selling that property. All that money is going to be tax-free up to $250,000 as a single filer, $500 as a joint filer. So that's another thing to consider. Instead of tapping the home equity, you could also sell, get that tax-free cash, buy multiple properties with it. Maybe you buy an investment property and you buy a primary. So there's a lot of strategy considerations, a lot of tax considerations. So always talk to your CPA and come up with a great strategy. Where are you at in life? Are you self-employed? Are you a W-2 employee? If you're a W-2 employee, there's only certain things you can write off depending on your income. So there's a lot of things to consider. So it's always important to consult your CPA when making these moves. So if you made it all the way to the end of this video and you want to set up a strategy call, I would love to chat with you. We'll talk about your current assets, your current equity, your current real estate, and we'll come up with some great strategies for you. It doesn't cost you a dime. I'd love to chat with you. And if not me, talk to somebody qualified, map this out. Don't wait. This is how you build true wealth. Talk to you soon. Bye-bye.